So when I sit with friends, people typically in the early 40s, late 30s, at some point of time, the discussion definitely gravitates towards investments, personal finance, or the stock markets. That's absolutely fine. But what always surprises me is the range of products that we as a group are invested in. Real estate, fixed deposits, gold, bonds, mutual funds, stocks, small case, PMS, futures and options, P2P lending, crypto, fractional real estate, and many more. In fact, one of my friends is invested into 14 different products, but when I asked him to recall the exact nature of the products or to give me an estimated annual yield, this man drew a complete blank. I'm sure some of you can relate to this. So complexity has this habit of building up over time, and so in this video, I'll be presenting some tips, tricks, and techniques that you can apply to simplify one's investing. Believe me, there is nothing here that you don't know, but what I hope to achieve here is to kind of organize your way of thinking, and there are 7 areas that one needs to address here. Let's begin. The first box is our behavior, and it's often our emotions, our biases that introduce significant complexity in our investing. Unfortunately, this not only messes up the portfolio, but also leads to suboptimal decisions. For example, the period from 2020 until 2023 has been a strong one for the Indian stock market. And if you've made 30% return, then it's probably on par with what a lot of others have made. But then many individuals, including this client Sumesh is referring to, seems to have become very confident, overconfident of his abilities. So that's behavior flaw number 1. And secondly, there's obviously a recency bias, because while the client remembers the last 3 years where he made 30%, he seems to have forgotten the previous 2 years, 2018 and 19, where he might have struggled to make even 10% returns. So not recognizing one's bias adds complexity to investing, and to simplify things, here are 3 highly effective strategies that everyone should employ. Number 1 is education, and I highly suggest you read every article on this website, fs.blog, especially the section on mental models and decision making. The second simplification way is to ignore noise and to follow a system for most things, which includes your asset allocation, SIP, the selection of funds, the style of investing, etc. And the third technique, which is very specific to stocks, is to have a checklist which clearly addresses why you are buying into that particular company, what do you expect from it over the next 3 to 5 years, and what it would take for you to sell that stock. As I said earlier, none of this is rocket science, but the application of these steps can be the difference between a simplified and complex form of investing. So once again, accept who you are, recognize your biases, and instead of running behind everything, follow a system or checklist. In one of my consultation calls, the person I was talking to was a little upset about the markets. Not now. This was maybe a year back when the Nifty had fallen by 10%, and throughout the call, this man was simply venting out. He wasn't abusive, but you could make out from the things that he wasn't very pleased. And that's when I asked him, hey, what percentage of your portfolio is in equities? To which he replied 5%. So to put it mathematically, all this bickering was for almost nothing. And as a portfolio, his worst case scenario is that he hadn't made any returns over the last 3 to 4 months. The larger picture here is that this person was missing the point that wealth creation is actually more about portfolio building. Now, I've already posted a few videos on asset allocation and portfolio creation, so we won't go there. But to quickly recap, and from a simplification perspective, here are 4 things that everyone should consider doing. Firstly, split your portfolio into a core and opportunity segment, and in my case, it's 80% core and 20% opportunity. Number 2, define a portfolio split for your core portfolio, and I personally prefer 60% in equity, 30% in debt, and the remaining 10% goes into gold, REITs, and InvITs. If you're not sure what InvITs are, then please don't read my newsletter. Yes, you heard that right. Don't read about the 12% yield opportunity that I've discussed in the newsletter until you've understood the product itself. And finally, point 3 in our portfolio simplification exercise is to rebalance regularly. Now, to prove a point, I took this image on asset returns that was published on Mint last month, and I applied it to my own portfolio setup. So this is my targeted asset allocation, the way I'm most comfortable with. And for the year 2013, when I apply the returns across assets, my weighted portfolio return comes to 1.1%. As you can see here, 2013 was an year of extremes, with international equity doing extremely well while investments in mid caps, small caps, and gold struggled. Actually, I want to show something interesting here, and if I take a marker and map out small caps through these 11 years, we can clearly see the volatile nature of the asset. Even gold shows up in a zigzag pattern, and so does mid caps and international equity, which clearly points out to the up and down nature of individual assets and why it is important to diversify your holdings. To put this in numbers, if in January of 2013 I had invested my entire wealth in large caps, that is the Nifty 100, then after 11 years it would have given me a return of 12.6%. In comparison, my diversified portfolio would have delivered an almost similar 12.3% without rebalancing, and with annual rebalancing, it would have come to 12.1% but with slightly lower volatility. So while diversification and rebalancing might look like a lot more work, but honestly, once you get a hang of it, it won't take you more than a couple of hours every year to get this right. Right, so many of us have our SIPs running, and every month some money gets deducted from a bank account and we allocated some units. So there is convenience, there is transparency, rupee cost averaging. One doesn't need to time the market, and over time it all adds up and helps us build a nice big wealth corpus. In the same context, one can simplify their PPF investing by setting up a standing instruction. The same goes for insurance premiums, credit cards, NPS, and so on. In fact, automation can also be applied during withdrawals, and using an SWP feature, a systematic withdrawal plan, one can pull out money from one of the mutual funds at regular intervals. Similarly, for moving funds from one scheme to another, a systematic transfer plan or STP can be utilized, and instructions can be given to the fund house to move X amount of money from one fund into another at particular intervals. My point is, to the extent possible, simplify your investing by making use of automation facilities which are already inbuilt into many financial products. Correct me if I'm wrong, but every year or two, we tend to receive some sort of lump sum money. This can be your annual bonus, some fixed deposit that has just matured, a wire transfer for some side project, etc. And every time this money comes in, most of us get into a state of confusion on what to do with this money. I know it's a personal call on how you want to use your money, but at least as a framework and to keep investing simple, I think there are primarily three deployment decisions that need to be taken here. The first option is to apply this lump sum money for pre-planned activities like buying a house, paying for something like a laptop, etc. So because you've already thought through it, and because a house or a laptop or a car is a requirement, one can simply go ahead and apply the money there. The second option is to keep this money as debt, in which case, and at least from my perspective, some part of the money should go into a 1 or 2 year FD or an ultra short duration debt fund, and the rest of it can be invested in a long duration product like a target maturity fund. And the third choice is on deploying this money into equities, which is where the STP feature can be utilized, wherein the lump sum money is first kept in a debt or arbitrage fund, and then a fixed amount of money is moved into an equity fund of your choice on a regular basis. Again, you can tweak this as you please, but to keep things simple and manageable, do consider creating a similar decision tree so that there is no confusion when such a lump sum money does come in. In my case, I've been using this framework for the last 5-6 years now, and for me, it's worked perfectly. Another source of complexity is this habit of chasing the best performing mutual fund. I'm sure a lot of us have tried this, me included, and I now realize there are two problems with this. Firstly, the set of best performers keeps changing every year, so if you do this for the next 4 or 5 years, you'll probably end up with 8, 9, 10 different schemes in your portfolio. In fact, I tried this on FlexiCap funds, and had I picked the top 3 performing schemes over the last 5 years, I would have ended up with a basket of 9 funds, which at least I would have had trouble tracking and managing efficiently. The second problem, and a more important one, is that schemes which do well, so quartile 1, the top 25%, not many of them retain their top performing fund status in the subsequent years. To prove this with actual data, I pulled out the performance numbers of FlexiCap funds over the last 10 years. I classified each scheme on which quartile they belong to. And for every scheme which was in Q1, I then mapped its quartile status in the succeeding year. What came out from the study is that schemes that were in the top 25% of any year, well, only 1 out of every 4 funds remained in quartile 1 in the subsequent year. In fact, a top performing scheme is more likely to become a quartile 2 fund in the very next year, with 37% of FlexiCap schemes meeting that fate over the last 10 years, and almost 40% of these best performers moving into Q3 or Q4 in the very next year. So what is the solution? For this, I went back to the data. I looked at the overall 10-year performance, and very clearly FlexiCap funds that have an AUM of 10,000 crores or more, well, noticeably all of them seem to have delivered performance within the same range. Of course, I'm not suggesting that you'll make 18 to 19% by doing this, but just to prove a point, I want to particularly point out to SBI FlexiCap, which has a 10-year CAGR of 18.2%, but remarkably, in all those 10 years, it entered quartile 1 only once in 2015, has spent the remaining 9 years in quartile 2, 3 or 4, and yet it has a more than acceptable 18.2% CAGR to show for its efforts. My point is, and what this data shows, is that over time, performance distortions get minimized, and established schemes, even though they have different investing methodologies, tend to offer similar returns over the long run. So don't overcomplicate your investing by jumping from one scheme to another, as I have been guilty of doing in the past, and stick to a set of 4-5 schemes of different investing styles and be invested in them for a long period of time. So I came across this post on X, the social media platform, and someone had written, while a stock price can go down to zero, I haven't heard of any mutual fund going down that path. Now, I'm not trying to compare the virtues of mutual fund investing with stocks. I'm sure there is a place for both in our portfolio, but the core theme here is to be more careful, more studious, and precise when it comes to picking stocks. So here are some ways by which one can simplify and improve stock selection. Number 1, don't get excited about every stock. In fact, studies have shown that a core holding of 10, maybe 15 high quality, high conviction stocks is not just easier to monitor, but beyond this number, one doesn't also gain much in terms of diversification benefits. Of course, this doesn't mean that you shouldn't or you can't take advantage of some tactical opportunities that I share in my newsletter, but to simplify and optimize a portfolio of 10, 12, 15 stocks is good enough. Okay, point 2 is to always have an investment thesis, that is a clear rationale for every stock in your investment portfolio. And this is where you answer questions like, why are you keen on buying that stock? How does the company make money? What is the growth potential? What are the risks? And so on and so forth. And the third simplification technique when managing stocks is to have your own investment criteria. This part is important because there are like hundreds of investing strategies, many of which I have discussed in this channel. And the reason I give you all this is to build your awareness that there are many roads to investing success, but eventually you'll have to pick your own path. For example, I know this person in the family who starts his selection process using a simple 3-step criteria. Question number 1, will the business be around 100 years from now? Number 2, does the company have a large and growing economic moat? And the third part of the puzzle is, does this company have a history of responsible and shareholder-friendly management? These 3 questions are his way of looking at stocks, and I'm quite certain that if you have your own simple criteria or checklist, it'll go a long way in choosing quality stocks, in putting your mind at ease, and more importantly, in allowing your investments time to mature. And the last, and by no means the least important step, in fact, it's a very important step, which is the tracking, reviewing, and consequently the regular cleaning up of your portfolio. It all starts with tracking, and there are 2 ways of doing this. A, you can put everything in an Excel sheet and figure out a system of updating values at regular interval. Or you can do what I do and utilize the services of an online portfolio tracker like Value Research Online or InMoney or mProfit, etc. So choose what works best for you, but the idea here is to have everything in one place, as it will not only simplify the management of your portfolio, but it also improves the review process. Personally, this track and review has helped me in many ways and continues to do so in terms of me understanding how is my wealth growing, which schemes are doing better than others, what's my portfolio asset allocation like, what kind of rebalancing I need to do, etc. For example, there was a time when I had no tracking process, and before long, the equity schemes in my portfolio were over 30 in number, which was obviously becoming very difficult to manage. But by using an online tracker and by reviewing the portfolio on a regular basis, so I would review every 6 months. So by tracking and reviewing and by consolidating schemes within the same category, I not only managed to bring down the number of funds, but even the portfolio performance had gone up because I started to become more selective in my choices. In addition to getting your asset allocation right, a track, review and cleanup process ensures that you have sufficient money to achieve your immediate and long-term goals. You can identify growth opportunities and that feeds into your opportunity portfolio. One doesn't take unnecessary risks like overexposing oneself to a single sector, stock or asset class. By keeping track, you can save taxes by using techniques like tax loss harvesting. You end up taking less risk, and most importantly, an organized investor is a peaceful and confident investor. So as I said it before, the 7 areas I've put forth today is not something that's new to you. But I hope by putting it into different sections, it gives you a better understanding of what to do and how to do it. If you have other ideas on simplifying your investing, please do share them in the comments box below. Once again, thank you for your time, and I'll see you 3 days from now. Until then.